All right. Well, good afternoon, everyone. This is Rich Swerbinsky with the Mortgage Collaborative here once again with the Rundown with Rob and Rich, now weekly, every Friday, 3 p.m. Eastern. And this week, we are fired up to once again bring back our friend, the co-founder of both Quick Mortgage Co. and Equilibrium Mortgage Solutions, Paul Campbell. Paul, thanks again for joining us, bud.
Thanks for having me, Rich. Great to be here with you.
We love Paul's perspective. One, he's way cooler than Rob and I. And two, he owns a mortgage company and he owns a fulfillment services company that does great work for lots and lots of our members, Equilibrium, that really helped lenders out, especially last year when things were so busy. People that were able to close loans in 25, 30 days, a lot of them because of Paul and Equilibrium. So Paul brings unique perspective to the table. And as always, Paul, a lot of stuff going on in the industry that we're anxious to get your thoughts on. So thanks for joining us, Paul.
Thank you, Rich. Always a pleasure.
I have a question. I'm gonna go off script here immediately, Rich. I hope you don't mind, but I wanted to ask Paul, given the Fannie Mae rent change in terms of underwriting, Paul, are changes like that a problem when companies have outsourcing going on or fulfillment? They've outsourced their fulfillment and so forth. I mean, how are changes like that handled with Equilibrium?
Actually, at Equilibrium, and great question, Rob. With regard to Equilibrium, we changed pretty much as fast as the industry changes. So we're getting updates from Fannie Mae just as any other lender does in Equilibrium, and we put those updates and we publish those updates to our teams. And then we find that our lenders, some of them whom have their own guideline sets that they provide for us, they're simultaneously giving us the updates too as they come into the marketplace. So when you look at Fannie Mae and AUS and having the ability to track rents, it's not going to come out until September. So we all got time to get into place. Same as what happened with the 1003, right? When we came out with the new IRLA, everyone had to prepare, even Equilibrium. And then we took individualized training from our various different lenders. So each lender had its own, it's supposed to be uniform, but each lender has its way and its own system. So we had to train for it that way. And then we went into steady state. Same thing. So with the rents, it'll be the same thing. We'll all know what to do. And we'll ensure that that'll be a part of our underwriting guidelines. It comes out on DU, LP, and it'll be flawless as usual. We all get it.
Let's start here because I'm curious. Like I saw, it's big news. Fannie Mae came out and said they're going to start using rent payments as part of their qualification parameters through DU. And
right.
Immediately I'm thinking, like, we know in the mortgage industry, like the percentages of delinquent loans and payments, that's things that, the big servicers and others make public. We don't know the percentage of rent payments that are late. You would have to think with this administration putting such a big focus on creating a level playing field for home buyers, that this is something that would be done to help people qualify. But what if you're late on rent payments and maybe that wouldn't have been. And I'd be curious, anybody in the audience that has any thoughts on this, there's no chance it could be a net negative thing, right, for qualifying people?
I gotta believe, and I'm pretty sure somebody will chime in, I gotta believe it's gonna be a totally positive outcome. There's gonna be so many people out there that are paying rents, and it's coming through their bank statements. That's gonna get picked up in AUS. It's gonna save a lot of time on both sides, and it's gonna give those an opportunity that have thin credit, if you will, to create a trade line right off the bat.
I think if I could chime in briefly, Rich, I concur with Paul. When you talk to loan officers, oftentimes they will say, boy, I wish I could find a program that really reflects the payments that this borrower is making on a monthly basis, whether it's utilities or their phone bill or rent, whatever it might be. The loan officer will say, I know these people can make their payments. And so for Fannie Mae to roll out this rent, accepting a rent payment, I agree with Paul. I think it's a good idea. I think that, but it does bring up a question, if I could, since I've got my on my soapbox here a little bit. The interesting thing is that, and Rich, you may want to talk about this at some point on the call today, but if Paul came to me for a loan and I said, Paul, you know what, Paul, I like you, like your hairline, and I'm going to loan you, $200,000, $300,000, $400,000 at 0% interest. And Paul, you know what? I'm not even going to look at your credit. I'm just going to loan you the money. It's free money. You don't have to qualify. You don't. And Paul goes out and tries to find a house, and he can't find a house because there's no inventory. It doesn't make any difference that I'm giving him 0% and I'm not even underwriting his loan. He can't buy a house. So it's a little bit of a two-edged sword when companies make credit decisions or credit guideline changes that'll help, I think, borrowers if there's no house for them to buy, if they still can't buy it. And you also have critics out there saying, you've got the Federal Reserve keeping rates low. They are helping this housing affordability issue because the low interest rates are keeping interest rates low. And so the price of homes goes up because of that. Well, you could say the same thing about credit guidelines. If you have loosening up of credit guidelines, that releases more people into the home buying arena and can also drive up prices. So I'll pipe down now, but I wanted to get that off my chest.
Well, there's a lot of good stuff in the chat, and keep it coming. One comment about Montana, where you are, Rob, where men are men and sheep are scared. I thought that was pretty funny. Someone asking if I'm in the witness protection program. Rob, we know, is in the witness protection program. But on the topic at hand, typically they are not 30 days late. They have to pay a late fee, but pay within the month. So that, I guess, wouldn't be reported as late. The guys from National Real Estate Post said missed payments won't hurt you in the past today. So past missed payments, I guess, won't hurt you. Only, I don't know what that means. So I guess only helps if you make them on time. One person, there's always a chance for negative. My question is, what if the landlord holds the checks for a few weeks before depositing? Another good point. So, and how much of an impact does this really have? Though I think many pay cash. I don't see a big impact with that. So yeah, all valid points, but anything that could help, I think level the playing field, welcome, especially coming off what we were seeing from Fannie and Freddie on this show and others, was not long ago. We were talking about caps on non-owner occupied and, the 2 of 3 rule and all these terrifying, crazy things that really would have put a clamp on credit. So well, moving on, and I'm so damn sick of talking about the pandemic, but it continues to impact our industry in a lot of different ways. The interest rate part of it, that's one way it's positively impacted our industry. We're pumping out refis again at same clip as we were in the winter, which nobody saw coming and nobody projected. Return to work, just so many of our members I've talked to these last couple of weeks that either had plans to return people to the office or to roll out some sort of formal hybrid plan, that they're kind of putting that on hold. Travel and conferences, a big part of our industry also potentially impacted by all that. So, Paul, I'm going to, I guess, start with you. You run a mortgage company and a fulfillment services company. The refi levels we're hearing, it's, long story short, industry doing way more refi than through 7 months of the year than we thought, and not quite as much purchase because of some of the impediments there. I guess if you could talk a little bit about the current business climate from the way you're seeing it, and maybe some of your thoughts on return to work, return to the office or not, based on the latest with the Delta variant.
Through the first 2 quarters of the year, the business has been pretty brisk. You see a lot of opportunity. I think we have more opportunity now than when we first started with Equilibrium. We're going deeper and deeper into our customers' platforms, meaning we're taking on more duties, if you will, from setup all the way through underwriting to post-closing. And we keep seeing that kind of build out. And I think that's got a lot to do with the pandemic. From my team's perspective, though, I got a lot of folks in India, and it's kind of amazing seeing the second wave, the Delta variant, if you will. A lot of folks are, a lot of our team members are catching COVID, to be honest with you. And it's kind of different because it seems as though in the US per se, when we keep hearing about COVID, we're like, folks are going to the hospital, deaths are increasing. But in India, when my staff, typically when they catch COVID, they usually are back on their feet in about 7 to 8 days. I don't know what that is. And there's a lot of people that are having challenges, don't get me wrong, but there's over 1 billion people, right? So my younger, healthier workforce is recovering faster. When we talk about quick in the States, we haven't had anyone, knock on wood, that's come down with COVID. But, working from home, being remote has come to the point to where we have folks that come into the office because we have centralized Salesforce, right? But they also have the ability to work from home. So we're not putting pressure on them. We keep the office sanitized, if you will, but we're giving them the ability to rotate. And we're kind of looking at go back to work. Are we gonna make them come back to work? But we just feel like that's kind of a slippery slope, and everybody's kind of being beholden to their own health. So we're making it simple and easy for them to work from home. We have all the ability in the world from a remote perspective. So we're using it, from a technology, communications. You got Zoom. We can monitor the work from home. So that's not a problem either. So we keep, productivity moving really well. As you know, when folks first went remote, productivity shot through the ceiling. And then after about a month or so, productivity started to drop because a lot of employees don't know how to work from home. But I think now that we're into it pretty far along, we've all adjusted. So we're keeping an open hip mindset, and remote is something that we want to keep in play. And who knows, after the pandemic, probably will too as well.
Before I go to get your thoughts on just, how the pandemic continues to impact our industry here as we're now, 16, 17 months into it. I could say one of the things that is a big topic of conversation amongst our members is productivity tracking of at-home employees. As Paul mentioned, post-pandemic last spring and summer, it was like nirvana. Oh my God, everybody's so productive. This is amazing. And, people were happy to have a job. People had nothing else to do because they couldn't leave the house. It was cranking on all cylinders. And then there was that burnout factor. Ops employees fall into the winter. It stayed really busy. What we heard from members in the spring in our collab labs is that productivity for at-home workers was really waning. Apples to apples, regardless of how much total pipeline volume there is, just looking at individual productivity. And some had started tracking the productivity of their at-home employees using a myriad of different tools that are out there. Some aren't telling their employees they are. Others are being transparent about it. And it created these really fascinating conversations amongst CEOs of mortgage companies and heads of mortgage banking divisions for depositories in and around this topic. Rob, I go back to you now, having thrown a lot of stuff on your plate, Delta variant rates, work from home, and productivity monitoring. So pick from there.
Yeah, where do I start? That's too bad if senior management doesn't let the employees know that they're being tracked. I think that the pandemic has given us, though, given managers a different skill set that's required for success. You can't just walk down your row of cubicles and see if Susie and Johnny are underwriting loans, because Susie and Johnny might be 1,000 miles away and might be taking their kids to preschool that hour or whatever it might be. So there are tools. You're right. There are tools that you can examine productivity with. The question is, to make sure that is what you're measuring in terms of productivity. Is that correct? Is what you're measuring correct? And if so, how do you increase it? I think Paul's answer was very, very good. I'm hearing just a real mixed bag, Rich, as I'm sure that you are, in terms of, okay, everybody back in the pool, everybody back to work, versus we're just going to keep working remotely. And Paul, I really do sincerely appreciate the fact that you said a lot of your employees are bouncing back who have been impacted. I think that's great news. What I get the sense of, though, Rich, is that a lot of people are kind of, they aren't quite rolling their eyes yet about this, but they're tired of it, and everyone's kind of tired of talking about it, and they kind of wish it would go away, or they do wish it would go away, or et cetera, et cetera, et cetera. But as lenders, we are in the unique position to offer a lot of our employees this flexible work environment. And getting back to Paul's point, to give them the ability to come back into the office or to work remotely. I think, frankly, from what I hear, a lot of people are anxious to get back in the office. They genuinely miss their coworkers. They miss, walking down the hall and grabbing some M&Ms, or whatever it is that somebody always has on their desk, and just the ability to chat. I know the conferences that I've been to over the last month or two, the attendees are truly interested. They were very excited about leading up to the conferences and seeing their, people they've known for decades that they haven't seen for a year and a half. And yeah, you can sit on a Zoom call with somebody, but it's just not the same. So they were looking forward to the conferences, and they've enjoyed the conferences. And so, I don't want to turn this into a political statement, but I think that people kind of want their lives to move on. And Paul, to your point, I think offering them the flexibility and work in the working world, I think is a great idea. So hats off to you.
Yeah, and I'll tell you, so I'm in California. I went into the corporate office in New Jersey over a month ago. And when I was on my way out, I fist pumped everybody in the office. It took me 20 minutes to leave. It was so amazing and exciting just to be around people after being, at home for over a year. So going into the office is amazing. And then another thing about remote work, we don't really know how to manage remote workers. We haven't had to do it. There's been some here, some there, but by and large, just having a large portion of your workforce remote, you've had to get up on your Zoom game and start having meetings. You've had to get better at employee recognition. You've had to get better at, skip meetings or one downs and really talking to your employees so they don't feel so alone and out of place. So learning how to manage remote, it's probably more difficult than working remote.
And it's a different skill set.
Yeah, I would say, Paul, oh, sorry, Rich. I was just going to say that the downside of working from home, oftentimes you end up, totally demoralized. You end up on poorly lit Zoom calls in brightly lit rooms with fans slowly turning behind you on the ceiling. That's really the downside of the work from home environment.
Yeah.
But it is a different skill. I've heard our members talk about this. We've talked about this with our team. It is a different skill set managing a room full of loan processors or loan underwriters that, you're there with and in person, as opposed to managing a team of people scattered across the country and being on video calls. And we've heard our members talk about that, like managers that they viewed as some of their better managers of people pre-pandemic, that had struggled with being managers in this new world. And it's something that I think all lenders are trying to figure out. And I think to your point, Paul, it's because in recognizing people, you can't walk over to their desk and it's tougher to schedule a 5-minute Zoom, but there are ways to do that, but you got to be a little bit more creative.
Yeah, and last thing, Rob hit it, nail right on the head. I was sitting down with Nishit Parikh, the owner of Quick Mortgage, and we were like, how are we going to monitor folks and what are we going to do? So we bought some tools, really cool technology. And then we had to make that big decision, like, do we tell them? Do we tell them how much we can see? And we erred on the side of caution and just told them, because it's just nothing, people feel as though you're a big brother or, you're invading their privacy. So we got it out there, and productivity did jump. And the good thing is we told the truth and we were honest with our team members, and they started to feel better about it. They forgot all about it. And we don't use it as a tool that, it's not a gotcha, it's not punitive. But it did, tighten things up, which is pretty cool, especially when we let them know.
And a lot of good comments.
I think that's, I was going to say, I think, Paul, that's very good. Getting, I don't know, Rich, if we want to, we could talk about Zoom calls and the pandemic for quite a while, but in general, when I talk to people, I'm reminded that this industry, we were very nimble last March and April. We shifted to this whole work from home environment almost over a weekend, and IT staffs did very well and people did very well, and we adapted. We had our knees bent, as they say, and we were able to keep helping borrowers. And now I think companies are being nimble again, and employees are being nimble. They're, work from home or work from the office or some kind of hybrid model. And I think that we continue to help borrowers. So it's once again a testament to the people in this business that we've been able to do what we have, given the circumstances. And, given the changes in the regulatory environment, given the changes with agency environment, and given the changes, the volatility in interest rates, we keep trucking, we keep moving along. And it's nice to see. I wanted to ask Paul, though, another question about Juneteenth, and not to beat a dead horse over the head, but the CFPB this week released their Juneteenth information, and a couple investors followed suit. How do you handle that kind of information? Or how did you handle Juneteenth at Equilibrium Solutions? When you have just a few days to react, tell me kind of what, if you don't mind, kind of what went on behind the scenes in terms of outsourced solutions, because I think sometimes companies worry about outsourcing things because they don't know how decisions are made or changes are made. So what happened when that, holiday was declared? What happened behind the scenes with you guys?
What happened was, it was like all of a sudden there was a new federal holiday. So your rescission period got extended, from a mortgage perspective, lender perspective. And then out in India, there was really no impact at all. It was just pretty much business as usual. For the simple fact that we've got like some 18 holidays out in India, to be honest with you. When you got US holidays, and then you have the holidays germane to, the Indian population, India itself. So when Juneteenth came about, it was more of an impact, like I said, with the rescission periods, and like, oh yeah, there's another day, you got to just wait now. We got to redraw docs and things of that nature, but it wasn't a big blip on the radar. It was a blip on the radar. It wasn't a big deal. It really wasn't, Rob.
That's good to know.
And a lot of good comments in the chat just about, work from home and the basically in and around the importance of lenders, taking care of remote employees and being creative in how they do so. And this change, and I feel like with lenders now, at least some lenders, and there are some that are like, they want to get back to the office and they're going to, and it's just when, not if not already. But others, I feel like, that were like 50-50 on it, that were close to doing it, they're more just maybe throwing up their hands now and thinking that giving all employees the choice it's the momentum that I've felt just these last couple months is, we've had the spike up in cases, and it leads me to wonder, like, the future of the retail model in mortgage banking. Like, before I took this job, I ran lending for a bank based out of Cleveland, Ohio. And, we wanted to, our plan was very simple. We wanted to grow in Ohio. And so we took a look at the state, and we took a look at the market share stats, and we went to Toledo and we went to some suburbs of Columbus, and we, leased buildings and, built out loan production offices and hired people in them. And now it feels like that is like a dinosaur model, that lenders are looking nationally more at a strategy, that bricks and mortar is not as much, if at all, a part of it, that they're being very creative in how they're looking to grow and where. And you would be curious, you guys, your thoughts on that matter. Paul, as somebody that runs a mortgage company and works with many others as a service provider, and Rob, just in your interactions. Paul, I'll start with you. The future of the retail mortgage lending model. What do you think? What direction do you think we're going in?
I mean, it's kind of up in the air, to be honest with you. I'm talking to a Western regional kind of guy, and he's talking about teams, and we're like talking about brick and mortar, and I'm all like, do we need it? Do we need it? And it's coming to the point to where we'll start off remote and see how it works. And then if we need to get into a space, we'll do the executive space. And then if we really need to go down that road and turn in and get a long-term lease, certainly in the back of my head, I'm looking at it like, I don't want to do that. I want to be as remote and cost effective as possible, because that's where we're at. I think as an industry, I think that's where we're at. The acceptance level is there. When you thought of somebody being able to work from home and have social security numbers and all these things, I know it's kind of scary, it's terrifying, but that's where we're at now. You got to have the tools, you got to have the technology, but folks working from home, I think, is the reality that's never going to go away. And I was going to say, it's just, I hired a couple people, and one of them's in Ohio, another one's in Georgia, for the back shop, another one's in Washington, Seattle, Washington. So I'm never going to say, okay, pick up and you got to move to the corporate office. So I'm already establishing the fact that my teams can be decentralized forever, and they can work from home. So same thing in the sales force, is kind of getting away from that cost structure wherever and whenever possible.
Rob, what are your thoughts?
So, Rich, here's what you need to do, Rich, for the big September event in Southern California. You need to have polo shirts made with a little slogan on them that says, "Work is a thing we do, not a place we go."
That's right.
Right. Work is a thing we do, not a place we go. Which once again echoes what Paul's thinking about it. But I think people like having some control over their destiny. They like being able to decide kind of where they work, and to some extent when they work, and what they're doing and so forth. So I think, going back to what we were talking about 5 or 10 minutes ago, I think giving them some flexibility and some options, letting them weigh in on where they want to work is a good thing, with health concerns being of paramount importance. But the retail, Rich, I think what you might be asking about, though, is once again, are all the brokers out there and all the LOs going to be replaced by some internet, like making a flight reservation on Southwest Airlines? It takes all of 5 minutes to get from Cleveland to LAX or wherever you're going. I once again, I don't see that at all. I think that retail loan officers serve a huge purpose, and we saw so many of them provide lifelines to borrowers throughout 2020 that they were a touch of humanity for a lot of borrowers, and they're there to answer questions, and it's, the loan process is still a confusing process, and people really value their loan officers. They don't want to necessarily deal with the internet. They don't want to type a question into some void on some website about getting a loan. They want somebody to talk to. So I don't see the retail loan model going away at all, frankly. Maybe I'm wrong, but I just don't see that happening.
This is The Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and back this week, co-founder of Quick Mortgage Corporation and Equilibrium Mortgage Solutions, Paul Campbell. And I agree, like retail mortgage loan originators, I feel like the industry will go more consumer direct gradually over time as more people get comfortable just Googling slowly and incrementally young people to get their mortgage. But I'm, just in talking to some of our smarter members and thinking about how I would think of it if I was still a mortgage lender and I was tasked with growing a retail mortgage lending platform. It feels like it's more of a strategic national approach as opposed to any kind of geographic based on where leadership is. A new partner company we brought on, Model Match. There's other companies that do similar things. There's so much data out there. I think in general, companies have done such a good job procuring data that is useful to executives at mortgage companies. If it's market share statistics in particular regions, where that business is coming from, what realtors are referring it out, what loan originators are doing that volume. And if you're smart and have the right data providers and the right connections as a mortgage lender running a mortgage company in San Diego or Cleveland, or are there mortgage companies in Montana? I don't know, but that you can look at a national picture and be like, hey, there's opportunity in North Georgia, based on and I think that's the way a lot of leaders are looking at it now.
Yeah.
Rich, I need to defend. I'm not a resident of Montana, but I am up here to trap squirrels. Squirrel pelts, I think, are used as collateral in some of the markets up here. So, but there are mortgage companies. In fact, Man Mortgage is headquartered up here. Glacier is up here. Banner Bank has a big presence. So, I'm gonna defend the mortgage industry. Anyway, but I'll let Paul answer that question now that I've spouted off.
You did. Man Mortgage is proud of you, Rob. Definitely. When I look at it from, physical folks out on the street, shaking hands and talking to, borrowers. Absolutely. I'm not so sure. It's a debate every day. Like, is everything going to go the consumer direct route? Maybe sooner or later. I think more later than today. But a loan officer does so many great things for a prospective borrower that right now that's kind of, if you're going to run a retail platform, I think you got to have folks out in the field talking to people, because we're people, we're humans. Like I said, walking through that office and fist pumping everybody, I can't tell you what that did for me internally. I felt so good. I mean, the energy rush was huge. Like I literally can't wait to get to India. I mean, I can, but as soon as I'm able, it's just going to feel so good to be in front of people. So borrowers want to look at someone, have a sense of confidence, know that their loan's going to get done, feel good about it. That's why realtors are out there, right? So I don't see loan officers going away anytime soon. I do see the tools that we use to originate loans becoming more sophisticated, and over time, and I just don't know what that time is, those tools will eat away at having a huge sales force, but I don't think a sales force out in the field is going to go away anytime soon.
No, I mean, Rich, even look at how complicated. I mean, I'm not going to, once again, we're beating this topic a little bit, but yeah. I mean, even simple thing, and maybe I'm a Luddite, maybe I'm a technology Luddite, and I freely admit that, and I can only do certain things with my flip phone. But how many times have everybody on this call been on a call with something you hope is simple, and all you do is you're like keep hitting zero to try to talk to somebody, or you're waiting, you go through these menu selections with your keypad, and all you want to do is talk to somebody to ask them a question. And that's for simple things like, changing your phone plan, or, doing something with your bank account. Given how complicated mortgages are, people, they like talking to people. And I would argue they like talking to the same person. I mean, I think we've also all been in a situation where you have an account, or you're doing something with some company, and every time you call, you have somebody else pick up the phone. and they click, let me bring up your account, click, click, click. And sometimes the information baton is passed to that next person through the computer system. And sometimes it's not. Sometimes you have to start all over, and it can be a real problem. So yeah, I definitely think loan brokers and mortgage loan originators in general aren't going anywhere fast. And Paul, you're probably seeing that as well. So.
This is the Rundown with Rob and Rich. We've got about 5-6 minutes left in the episode, and it's going to be really interesting to see how this all plays out. I can tell you this right now, there's a lot of companies with a lot of money behind them that are betting big dollars on the demise or elimination of the human realtor and loan originator. The iBuying craze that we're seeing right now, Zillow and Open Door and other companies like that are really just putting tons of money behind their belief that people would be willing to sell homes online for a lower commission. And in our part of the business, the lending part of it, you've got companies like Zillow, and all the big more real estate brokerages, Redfin and others that are getting heavily in the mortgage right now. So it's going to be interesting to see how it plays out. But 5 years ago, I remember at our conferences 5 years ago, having a futurist in and, talking about the potential demise of the loan originator. Here we are 5 years later, loan originators have gone nowhere. We're still wet signing loan documents. I can't believe that one either. So it brought up blockchain. There was an acquisition, blockchain company merged with Homebridge, a big IMB, caused some chatter within our network amongst the members, just about that technology. And, like the ones I talked to kind of scoff, like, we're still wet signing documents. Like, don't even talk to me about blockchain. So
yeah, blockchain is an interesting topic only because it reared up a few years ago, a year or 2, 3 years ago. Everybody was talking about blockchain, how that was going to do this and do that, put every title company out of business and MERS out of business and so forth. And it hasn't happened. And the best quote that I heard was that blockchain was a solution looking for a problem. And I still believe that, but I think at some point it'll be very useful. Going back to my technology Luddite status, though, I've written about blockchain quite a bit, and I still have trouble understanding what it is and how it works. And I think for the average person out there, maybe they're kind of in the same boat. They know what a loan officer does, or they know, what an underwriter does. But when you talk about blockchain, it does get complicated in a hurry. So I hope it makes companies more efficient.
Yeah, in theory, the technology works good with the mortgage industry and transactions, but again, it just we've seen this industry's history with new tech. So moving on, a couple other things in the news. Adam Data came out with a report. Over 34% of all homeowners in America with an LTV below 50. That really, and I know that homes have appreciated recently, but that really caught me off guard. I was shocked by that number. Did you guys shocked there?
I'm along those lines, Paul. What? First of all, Rich, you stumped me. I didn't see that, but Paul, exactly along those lines, Rich. Paul, what are your LOs telling you in terms of are they seeing a lot of interest in cash out refis right now?
No, we haven't started running across a whole lot of cash out refis. I think with the run up in the marketplace, with appreciation, the way it's kind of wild, yeah, that 30% under 50, that makes sense. Totally makes sense. I think cash out refis will be the next wave, probably Q3, Q4. Haven't seen a lot of them, but it totally makes sense. But we'll see. I think rates are going to, trend up and down as they are doing. Folks are really kind of trying to sit on their equity instead of use it like they have in the past. So it'll be very interesting as we go forward. And I think someone just said, what's the average age of the home buyer or homeowner out there? where you see, if you could equate the age of the homeowner with the LTV, or you know, the value of the property, is it 50 LTV or whatever it is, it'd be kind of interesting to see what that looks like. I would imagine it's still older ones, like my parents, you know, their homes are paid off and they're going to pass that down, or kind of a thing. I don't know if it's folks under 40 or under 45 or even under 50 where they have that much equity in their property. It'd be interesting to know that data.
And let's end with
Hey,
this.
Rich.
Yep.
Well, I was just gonna plug my commentary for tomorrow, because I was writing it earlier this morning, and I do have 4 or 5 companies that people may not have heard of, that have either raised money and or are trying new things out there in terms of eliminating people and making things more efficient. So check that out. And
Sure.
and one of the comments that flashed up indicated that Open Door lost 144 million last quarter, which is a pretty good chunk of change. I can't verify that, but if that's true, that's a lot of money.
Their stock price rallied on the release. If that is not indicative of the stock market right now, I don't know what is, but yeah, crazy. Let's end with this. The Fannie Mae does a really good job with their housing sentiment index. Basically, Fannie Mae's, is interviewing, I think it's 1,000 random homeowners and renters each month, with some really interesting stuff that came out of the report this month. 28% of people think it's a good time to buy a house. Only 28%, but 75% think it's a good time to sell. That even with that, only 5% think rates will decrease. 57% think they will increase. And 27% of people said their household income has significantly increased over the last year. Only 12% on the flip side saying their income has significantly decreased. So a lot of interesting stuff in there. And I guess where I'm going all this is I'd love to get your guys' thoughts. And Paul, I'll start with you here. The current state of the purchase market, to me, it feels like there are a lot of sidelined wannabe buyers right now, like more than and this is just anecdotal gut feeling for me. I feel like there are so many sidelined wannabe home buyers out there right now that are on the sidelines for one of a few reasons. They were sick of the run up in prices, think that you're going to get some mythical market crash and they're waiting for that, or are just kind of biding their time. Maybe they bid and lost on several different houses. Maybe you got the person that is in a house and wants the next level house and can't quite afford it because you've seen more appreciation at the higher home values. So Paul, your thoughts on my theory that we've got a ridiculous amount of sideline buyers right now, and that and what pushes.
I think appreciation is gone up at such a rapid pace that a lot of folks that are out there that are renting, that want to buy a home, that are well qualified, it's kind of getting away from them, to be honest with you. The cost of buying a home. Great time to sell for sure. And there's so many aggregate buyers out there that if you put your house for sale today, it'll be gone tomorrow, pretty much. And that's corporations, in my opinion. But just the average person that's out there looking for a home, now's the best time to buy, which we should all tell them, because at this point in time, home prices are continuing to go up, and it's getting to a tipping point to where it's kind of out of reach for a lot of folks, especially first-time home buyers or that step-up buyer. What's the step-up buyer stepping up to? I mean, they have to pay quite a bit more to get more homes than they currently have. And I don't even know if they have the appetite for it, even with the equity that they did gain over the last, 2 or 3 years. So Rich, your guess is good as mine as far as what's going on out there with regard to people on the sideline, but there's a myriad of reasons as to why they are still on the sideline. I would say that because mostly anybody that's thinking about selling a home, they're selling a home so long as there's enough equity before they can go up, or they're going to step down, and it feels good to just take a step down. A lot of people leaving California going to Tennessee. A lot of people leaving California going to Montana. Californians are going everywhere, but that's because they got so much equity that they can step down into a bigger home somewhere else. I don't know if that's a trend for the majority of people looking to buy a home.
Yeah, I think Yeah, I think anybody who has purchased a home in the last 3 to 6 months has made a huge mistake. Rich, when did you get your place?
Honestly, I bid 20 over asking and got it. And then now the house across the street is going and just sold for 20 more than I just bought for. So I feel validated.
No, I think we've talked about this before. The demographics support that argument. People in their late 20s and 30s, they want, I think in general, I mean, for a long time, we were talking about millennials. Are they ever gonna, are they ever gonna get married? Are they ever gonna buy a dog? Are they ever gonna want to buy a house? Well, here they are. They're buying houses, just like the generation before them, and the generation before them, and the generation before them. People need a place to live, and granted, there's going to be a certain percent of the population that is happy with an apartment they don't want to own. They're happy to pay, BlackRock rent every month. There's another segment of the population that they're going to pay whatever it takes to buy a house. There's another segment of the population. I mean, there's different parts of the population, and there are different parts of the housing market that, do you want to buy a co-op in Manhattan for, 1.4 million? Maybe not. So certain price points, you get to a certain price point in many markets, and it's like, you know what? No, that's not going to work. But I'd say starter homes are getting snapped off the shelves as soon as they're built, or as soon as they come on the market.
Yeah.
Well, another lively discussion, fellas. Thank you very much. And Paul, appreciate you joining us again this week, as always. And for all that you've been doing for our members with Equilibrium. I've told this story before, but Paul joined TMC as a lender member, and I was talking to one of our members at a conference about outsourcing, and he's like, "You got the best in the biz, like in the next room." I'm like, "What?" And I'm like, "Who? Paul?" And I didn't even know that you had this side company, and we brought you on a TMC, and one of the most widely used and highest approval ratings of any of our preferred partners with Equilibrium. So appreciate you as a lender member and a preferred partner, and everything you do for our network and our members, and for joining us this week.
Hey, Rich.
Absolutely.
TMC's been a dream all along. So thank you. And we're always here at Equilibrium and Quick. We'll do anything for you. Just let us know. We appreciate TMC mightily. And you as well, Mr. Rob.
If you want to get ready, that when all these purported home buyers come off the sideline and pipelines swell up again, you don't get caught with your pants down like a lot of lenders did last summer and last fall. You got to have some sort of outsourcing solution at least lined up and ready to go. Because remember, everybody wanted to add you in the fall. When it was like it was tough. It was so busy that it's good to have those things in place. So appreciate it, Paul. Rob, what do you got going on this weekend? Are you in Montana all weekend? What the hell are you doing in Montana?
Trapping,
fishing.
Nice.
Shooting off fireworks in the dry brush.
You could probably do anything, right?
Yeah, the unofficial slogan in Montana is "Don't tell me what to do."
Oh, I thought it was where men are men and sheep are scared. No.
Yeah.
All
right.
Enough Montana jokes. I do love Glacier Bank if they're on. I do love Montana and Glacier Bank. So, but Paul, anything good for you this weekend?
So no, not at all. I'm gonna rest. I just put my last child into college. Actually, it's her sophomore year. She did the first year in the pandemic. We went up to campus. She's got a beautiful apartment, fully furnished via mom and dad, which is amazing in and of itself. So
Cal
I'm good.
Berkeley,
I'm gonna
right?
rest.
Cal Berkeley. Yeah.
Cal Berkeley.
That's
Go
gotta be
Bears.
cheap.
It's pretty cool.
Yeah, very cool. So excellent. And to our viewers, thank you very much for spending some time with us this Friday afternoon. And we are now in a weekly format, so we'll be back next Friday at 3 p.m. Eastern for the rundown with Rob and Rich. And until then, have a great weekend, everyone. Take care.